Following program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments, surpassing the markets in the long term. The information shared in the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
So here we go again. It is about money. We are the answer about money. Talking to you. And this week is one of the worst weeks we've had in the market. Are we in correction territory? A lot of tech stocks sure hit correction times. Some pundits are already calling it a tech wreck. So we've got more to talk about. That's going to come later in the program. We'll talk about this whole thing, what's going on, why it's going on, what to expect. That's coming later in the program. I have a great guest today. It's an important business. It's something you understand what they do, but you probably don't understand who does it. That's coming later in the program. But I want to start back in 2002. Jiang Zemin, who was the president of China at the time, 2002, spent time at Crawford Ranch with President Bush. And they started talking about something, in my opinion, was very significant. I don't know if it was a response exactly to Bush, a negative response, if it was a philosophy. It seemed to be something that the president of China was upset about. And he said that the United States is a young country, 200 years old, whereas China was a country that was 4,000 years old. The United States made plans for 5 years. China made plans for centuries. Very, very significant difference. That's going to come into play. We're going to talk about that in a few minutes, but I want to start talking about for centuries until this current generation, for centuries, for millenniums, most nations spent a lot of their wealth and a lot of their energy building for warfare. They raised barriers to trade, they raised barriers to interchange with other countries, and they only dealt with other nations when they felt it was to their benefit. But that's changed during the last several decades, especially since the Cold War. If you look at military spending, in 1985, global military spending in today's dollars was $1.5 trillion. In today's dollars, global military spending is $1.7 trillion. You'd expect as population increases that the military spending would increase in the same ratio. But if you look at it, in 1985, per capita spending on military in today's dollars was $365. In 2008, it had dropped to $226. Today, it runs around $230 per capita. We're spending half as much on military as we spent in 1985. In 1991, military spending as part of worldwide GDP was 3.3%. Today, it's down to 2.2%. So we're seeing spending by nations in other aspects of the economy rather than military. And if you look at the number of conflicts, according to the Center for International Development and Conflict Management, if you look at the country-to-country conflicts, from 1950 to 1989, you had a steady growth of conflicts. Every year, you seem to have additional conflicts, small conflicts, civil wars. You had things going on inside the countries. But in 1989, the number of conflicts peaked. And it has been declining every year until 2017. We had a pickup in 2017, a little bit of a pickup in 2018. If you look at the number of people that have been killed in conflicts, we had a little pickup with the Iraq War. We had a pickup with Afghanistan. But in general, the number of people wounded and killed in wars has been on decline since 1991 as well. For over 60 years, we've seen a change in what's happening in the military. So it's really a chicken and egg question. What happens in terms of global trade and reduced warfare? Per capita military spending is down 40%, while trade is up 12-fold. Military spending down 40% per capita. Trade per capita is up 12-fold. It's a situation which presents itself for implications for investment, but it also comes back to that question in 2002 when the president of China said, "We plan for centuries. America plans for only 5 years." China's plans are for the centuries, and you begin to think about that in terms of what's happening now. Yes, China has a 5-year plan, but it appears that as the second largest economy in the world, only the United States is bigger. Their plan is really to eat our lunch. They want to lead the world, not in 5 years, but as the century rolls on. That's their idea. Their 5-year plan is set so that they dominate in key industries. They want to be dominating, world dominating in those industries. If you look at where we are, as we withdrew from TPP, China stepped in. They wanted to control trading within the Pacific region. As we withdrew from Climate Accord, China stepped in and said that they would take the lead. We put tariffs on our European allies, and China is trying to negotiate pacts with them to do trade deals. Made in China 2025 was their grand scheme to bolster their key industries, to dominate high-tech industries. And that was huge. But what was even bigger, in my opinion, which has flown under the radar for the most part, is what they call their Belt and Road Initiative. They want to rebuild the Silk Road. The Silk Road wasn't just one road from China to the Mediterranean Sea. It covered most of southern Asia. China wants to reconstruct that. But now, not as the Silk Road, but as the Silk Planet. The Belt and Road Initiative, for them, the road means controlling the seas. For them, the belt means controlling the land. They want not just a road that leads from China to Europe. They really want to control around the world. China's ready to finance that. They're getting ready to lay out, and are already laying out, trillions of dollars to implement the Belt and Road Initiative. They have put an initiative to control the Arctic Ocean. They've done an initiative to control cyberspace, and they want to control the Pacific. They want to go through Europe to control the Middle East and Africa. And they're committing trillions of dollars of infrastructure. They want to build roads, railways, ports, power stations. And they're pouring money into countries like Azerbaijan and Georgia. Those countries that used to be part of the Soviet Union are receiving a lot of money from the Chinese. I have friends and business associates in the country of Georgia, formerly part of the Soviet Union. He said, Chinese money is everywhere. It's just pouring in millions and millions of dollars. Not only the dollars, but the Chinese themselves. The China is focused on Tajikistan and Kyrgyzstan and Kazakhstan. They want to strengthen them economically, and they want to defend the western border of China. They want to also keep them from becoming hotbeds for Islamic terrorism. In some cases, it's beginning to worry some of the developed world. Along with the cash, when they control, you can't question human rights, you can't question corruption, or intellectual property. Chinese are requiring Chinese labor, and they're doing it with debt. It's not like USAID, where we allocate certain funds as part of our aid to those countries and allow them to buy products from the U.S., allow them to buy products from other countries. No. In the terms of what China's doing, they're actually making loans. They made a loan that's an example of this to Hambantota. It's a Sri Lanka port. Chinese companies are the ones that are doing the loans. They're loaning it to governments. They're loaning it to countries, companies that are in those companies. But when Sri Lanka defaulted on the debt, the Chinese Navy took over the port. Today, the Chinese Navy is harbored in the port of Sri Lanka. It now belongs to China. Pakistan's election, the politicians took credit for all the Chinese investments, but the Chinese investments come with handcuffs. There is something with that. Right now, it's a very secretive thing. Macron, the president of France, has already said he is worried about the countries benefiting from the Belt and Road Initiative will actually become vassal states to China. We're going to come to a commercial break. Don't go away. We're going to finish this up and the implications for investments. Don't go away. We'll be right back.
More About Money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
I've been talking about what's happening in the world. The number 2 economy wants to overtake the number 1 economy. That is, China wants to replace the United States as the number 1 economy in the world. But it goes beyond just replacing us as the number 1 economy. They want to replace us as the number 1 leader in the world. And they're in the process of what appears to be trying to create vassal states with all roads leading to Beijing. They're loaning money, huge amounts of money, to companies in countries. And usually that money is guaranteed by the government. So if those companies default, it becomes the property, eventually, of the Chinese government, because it's companies that are partially or completely owned by the Chinese government. And so when it defaults in Georgia, or when it defaults in Ethiopia, or when it defaults in Kenya, or when it defaults in Jordan, it becomes the property of the Chinese government. They realize something, that it's much easier and cheaper to buy a country than it is to go to war. For a millennium, countries devoted a lot of their energy and a lot of their spending, government spending, on military means. They didn't trade with other countries, and they only talked to other countries when it was to their benefit, primarily. Today, that's changed. Today, it appears that it's easier just to step in and buy another country than to go to war at it. China is rebuilding the Silk Road, only the Silk Road is not just a road that goes from China to Europe, to the Mediterranean. It's a road that they want to be at every single continent. And they're devoting trillions of dollars to it. Usually when China does something like a plan to build a 1,000-mile railroad through Kazakhstan, they publish it, they make it a big deal. Not this way. The Belt and Road Initiative is very silent and very quiet. The purpose, of course, is for China to bring all the nations to subservience to the Chinese empire. Anyway, that has some real implications for investments. It has implications for investments in terms of international markets. Think about Pakistan for just a minute. The people that ran for the president of Pakistan, they took credit for Chinese investment. They took credit. They tried to brag about how much Chinese money they were bringing into Pakistan. And that had a significant factor in the election in Pakistan. But they brought in so much money, they owe so much debt, they had to turn around and go to the IMF to ask the IMF to bail them out of their debt load. It's not a pretty picture, and it's not very obvious, but you can begin to think about some of the international companies which will eventually owe their life to the Chinese. I like to keep domestic companies. I like to keep the investments here. We know what's going on. But remember, too, I've talked about the supercycle. The supercycle is that time in which worldwide GDP grows at a faster rate than average. The first supercycle from 1870 to 1913, driven primarily by the industrialization of the United States. The second supercycle from 1945 to 1970, driven primarily by the rebuilding of Europe and the decolonization. And the third supercycle, which probably began in 2009 and probably will run until 2030 or beyond, is a supercycle driven by the emerging nations. Yes, China. Yes, India. Yes, the other nations. But that's also where China is focusing their efforts. It's going to be an interesting time. As the president of China said in 2002, the United States is a very young country. We planned for 5 years. China is 4,000 years old. They planned for centuries. It's something I believe that the American way of doing things is a way that's ingenious. Ingenuous? I got the word right, maybe. So I was yesterday, or this week, I was at the 20th celebration for Benaroya Hall. Benaroya Hall was conceived in the 1980s, late 80s, when I joined the board of the symphony in, I think it was 1990 or 1991. I can remember the first board meeting was on a Wednesday, and on a Friday, the symphony could not meet its payroll. It had a huge deficit. It had to deal with a deficit, and they had this vision in their mind of building a symphony hall, of raising $250 or $300 million to build a symphony hall, even though the symphony was on the rocks. It was, in many respects, it looked like it could have gone belly up. So the order of magnitude is that we brought the deficit down. We raised the money to build the symphony hall. And 20 years ago, this year, 20 years ago, 1998, the symphony played in the symphony hall for the first time. It was an incredible visionary thing to do. It was Jerry Schwartz that had the vision. It was Seattle who understood, and some of the great philanthropists from Seattle who understood that vision. But it goes back to that time of seeing a vision and wanting to move forward. I think that's the American way. I think that's the American dream. Understanding that even in a time when the symphony was in such difficult times, there was still a vision to move forward. I think that's what's made it America great. I think that's a philosophy which I don't know of any other culture, and it is a cultural thing. I don't know of any other culture that's been able to do that. And maybe I'm just not aware, but it is the American dream. Anyway, I want to introduce my guest. My guest is the CEO of Absco Solutions. Welcome to the program, Eric Slabaugh.
Why, thank you. It's good to join you.
So, Eric, why don't we start with your background?
Oh, well, I spent a year at the University of Washington before I got to come home and take over a failing family business. And at the age of 19, I started working full-time. And at the age of 21, I bought out one of the business partners, bought out 25% of the company. We were negative $78,000 owner's equity when I was 19, and about negative 70,000 when I was 21. I managed to turn it around. My business partner and I managed to turn it around by the time we were 26. And the company just celebrated its 40th anniversary now. So, which you were at, thank you.
Which I was at.
Yeah, thank you.
It was a great anniversary. Yeah. It was great to recognize the employees and to have them there, the vendors, the customers.
Yeah, it was, and some of the community members, and it was awesome to be able to name an award after my mom, who was one of the three founders of the company. So, yeah.
So why don't you tell us what Absco Solution does?
Yeah, we're a facility vulnerability mitigation company, and what that really means is we use the different life safety and security products, video surveillance and fire life safety and access control, intrusion detection. We use those products to integrate them into a unified information platform to both improve security and life safety, while also looking to address possible operational issues within a facility. And the client base that we serve is really large multi-site venues or campuses. People like the U.S. Navy. We've been you saw Seattle Pacific University at the event. Seattle Pacific University has been a client for north of 30 years. One of the things we honored at the event was if it weren't for Seattle Pacific University, we wouldn't exist. They took a chance on us when others might not have.
And something happened there a couple of years ago.
Yeah. They had a school shooting a handful of years ago. Unfortunately, there was a miracle that took place, I think, personally. But at the same time, the systems worked the way they were supposed to. The campus was locked down within about 19 seconds of security being notified that there was an action on campus.
So your system locked the doors and locked the campus down with the shooter.
Yeah, and I'd love to say, I'll tell you what, Mark Reed is probably one of the best security directors on the West Coast, without a doubt. For 30 years, he planned for the worst and hoped for the best. I've had other security directors tell me that their campus couldn't do lockdown, but that's okay. They were a gun-free zone. Mark was never that optimistic, fortunately.
So it saved a lot of lives. We didn't become.
It kept a lot of people in safe location. What really saved a lot of lives was the fact that the gun jammed and there was a young man who was prepared to act and really put himself in harm's way at the time, but did something very noble. Yeah.
But it was your system.
Yeah, our system did what it was supposed to do. It really did secure a lot of people in safe harbors, and that's really what. The reality is we can't prevent the first bad action. What we can do is create safe harbors, and that's something that people in K through 12 and universities and in any large public space should understand. You can't stop the first bad action. What we can do is improve the situation and improve safety.
We're going to come back and talk about this right after the commercial break, so don't go away. There's more to talk about. But isn't this incredible to know? We'll be back.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I'm here with Eric Slabaugh of Absco Solutions. We've just been talking about Seattle Pacific and the shooting that happened there and the system lockdown. It was an ABSCO solution system. So let's talk about what your system actually does on campuses.
Yeah, so it varies from client to client based on their need. We really look to, the way I would say it is, my grandfather taught me something when I was a young man, which was the lesson of the levee. If I build a levee to 6 feet and the water rises to 7, I wasted 100% of my investment. If I build the levee to 8 feet, and the water rises to 7, I wasted whatever I spent on the last foot. But that incremental waste, nobody's going to care about.
Yes.
Now, if I build it to 20 and the waters never rise past 7, I didn't do my homework, and shame on me. The way we build our systems is the same way. We should build capacity to address unknown issues. But if you need a license plate from a car, and I put in a $120,000 camera system, and I can't give you that license plate, I wasted your money. If I spent $140 and I can give you the license plate, and it was really important you have that, and the police can arrest that guy, and I could have done it for $130, I wasted $10,000. Sorry, but it's okay because we got the guy, right? Yeah. That's important. Other things we can do, we had a logging company where they were shipping logs overseas, and they needed to be able to, they were pulling a truck in, and the security officer was actually writing down tags off the back of the logs to create a manifest so that they could then take the logs to the ship to be unloaded. And it was taking a lot of time, and trucks were backing up, and it was kind of a mess. Well, the same camera that we were putting in for security purposes, we could actually take a digital analytic view of the logs and instantly print a manifest in sorted fashion in a spreadsheet, cataloged with a video stamp, a time date stamp, the whole thing. I mean, it's really cool stuff. And now there's no backup because it's instantaneous. I mean, it's just really cool stuff. So,
and you don't have to worry. It's all there.
Yeah.
Computerized.
Yeah, absolutely. You've got a real record. Video analytics are amazing. Digital AI is becoming a very real thing. The camera systems themselves are starting to learn. So we have, when we talk about artificial intelligence learning what normal is, a car driving the wrong way in a lane is not normal. Somebody, there's never anybody in the building after 2 o'clock in the morning, and all of a sudden there is. Well, why? So we can alert, and we can create events that can alert somebody to pay attention to things. So we're really able to take something that traditionally has been a very passive, somebody's got to go back and look through hours and hours of events to try and find something. Something went missing and we don't know when. Oh, it was weeks ago. Let's go look through weeks of video to try and find that. To all of a sudden, it's almost instantaneous recognition that this event shouldn't be happening, and now somebody can intercede. And it's really changing the dynamic of how people manage their facilities and how they manage some of their operations. So it's pretty cool.
It is pretty cool. And it's, in one respect, it's when you talk about a campus, it can be saving a lot of lives. But for a business, it can be really saving a lot of money. And
yeah, it can be a real training tool. I mean, I think oftentimes our team wants to do the right thing, and sometimes they just need some additional instruction, right? They just need a little more coaching. And the other part is, when we don't know who needs the additional coaching everybody can actually be a demotivator. Whereas when we can give the right person a little more coaching, it's very motivating for everybody. It's like, oh yeah, I didn't get yelled at because some forklift hit the box. The person who actually hit the box got the coaching.
Yeah.
So,
no, it's marvelous to do. Marvelous company. So talk about, I was there at the 40th celebration.
Yeah. Saw
the original business in a house.
Yeah.
And moved in. You just moved into new offices too.
Yeah. Well, we just expanded our Linwood footprint. We have offices in Spokane Valley and then in Beaverton. The Beaverton facility is new as of this year. And then we're looking at a couple of other venues here over the next 24 months as well. So we are continuing to grow. We're growing about 40% year over year. The last 3-4 years, 30 to 40% year over year for the last, actually going on 5 years now. And I think a lot of it, I really can't take any credit for it. We just have an amazing team of people. We really do just have amazing people who do just amazing work. And it's really interesting. I do meals with the CEO every year where we ask 7 questions, and in groups of 2 to 10, every employee in the company sits down with me in advance of our strategic planning session. And then that information is given to our management team or anybody that's going to be in the strategic planning session, but absent who said what, so that the information is utilized properly and to help us build a great plan. And it's just really interesting to hear people say things about our culture like, this is such an amazingly safe, emotionally and physically safe place to be. I love that my opinions are valued, that you truly listen to what I think, and that if I have a good idea, it's acted upon. Mm-hmm. And so I just love that our team brings their best every day, and it really is allowing us to grow as an organization. So,
and I think that was obvious from the celebration of the 40th anniversary. Let's talk a minute about what are the type of customers that would be coming to Absco Solutions.
So, we do a lot of large multi-site or large campus environments. So CenturyLink Field is a really good client. Nordstrom, Seattle University, Seattle Pacific University. We probably do 40 college or university campuses. We probably do 40 or 50 K through 12 school districts in the greater 5-state area, 4-state area. We do a lot of distribution centers. We do hospitals. We do a number of hospitals in the region. Really places where they're looking to integrate the systems. We do a lot of government facilities where they're really looking to utilize the systems in a robust fashion to solve real challenges and to enhance life safety and security. So it's really the combination of the two is a great way. The solving business challenges actually produces a return on investment and enables them to get to do more solving of life safety and security issues. So, yeah.
Well, it's been an impressive thing to watch and see.
Yeah, you've known me a while, so thank you.
And I've known you a while.
Yeah, thank you.
So
it's been fun.
So how would somebody contact Absco Solutions?
Well, we're obviously on the internet, abscosolutions.com. So we're there, and our Linwood office is, our phone number is 425-771-1166. People are welcome to call, and if they heard me on this, they're welcome to ask for Eric Slava, although you'll likely end up working with somebody else pretty quickly. I'd be happy to show up and talk about strategic planning, but after that, I'm probably the wrong person to work with. So
understood. So again, the website is
abscosolutions.com. Yep.
So thanks for being on the program.
Well, thank you for having me today. Yeah, thank you for having me, and thank you for everything you're doing in the community. I truly appreciate it.
Thanks. So I want to turn and talk about markets. 1841, Charles Mackay wrote a book called Extraordinary Popular Delusions and Other Madness of Crowds. And he talked about a couple bubbles. One was the South Sea bubble, 1711. John Blunt got exclusive trading rights to South America, and he built a company which collapsed. I also talked about tulip mania, and people talk more about tulip mania than anything. Mid-1600s, somebody brought some tulip bulbs from the Ottoman Empire. It was a luxury item and highly desirable. And as they planted these and as they began to harvest these, prices began to increase, and there began to be speculation in tulip bulbs. By 1634, prices were really skyrocketing. By 1635, 40 tulip bulbs were bringing 100,000 florins. The average yearly wage of workers was 150. So this was equivalent to 1,000 tons of butter. It was equivalent to 3,000 sheep. It was equivalent to 25 oxen just for 40 tulip bulbs. By 1636 in the futures market, 2 bulbs were worth 12 acres of land. And many people became rich. By February of 1637, there were no more buyers. Prices crashed. The bubble burst. We lived through one bubble back in the dot-com time. We lived through a time in which the valuation of stocks took off and the price to earnings and balance sheets and income statements, cash flows meant nothing. It was all about the dot-coms and the number of page hits. And it was a new paradigm of investing. And it was a time in which I heard again and again people say, this time is different. Tell you something, this time is never different. We're coming to a commercial break. Don't go away, because I want to talk about this in terms of what's going on in the market today and where things are headed. Yeah. During the dot-com time, there were day traders. I used to go to the gym, and there were all these gym rats that were talking about day trading stocks. That was a time. That was a very special time, and it came to an end. We're going to come back right after commercial break. We've got a lot to cover. Don't go away. There's so much.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I started talking about bubbles, and I have to say, during the dot-com time, I was really early in the internet in buying internet stocks. Bought a couple of them a long time before everybody else did, but there was a time in which I was really getting queasy and feeling a little worried about what was going on. And I was in the grocery store, and I've told this story any number of times, but I was in the grocery store, and there were 2 young women ahead of me, and one was saying to the other, "You've just got to buy stocks," she said. "You can charge them to your Visa card and only pay 18% interest." And I thought, we're headed for a crash. When there's no more buyers, it all goes down. And that brings me to the FAANG stocks: Facebook, Amazon, Netflix, and Google. 4 stocks. But if you look at those 4 stocks and look at where we are, they're less than 1% in terms of numbers of the Standard & Poor's 500. 4 out of 500. And yet if you look at the gains from 2016 to the middle of this year, 20% of the total gain of the Standard & Poor's 500 was due to just 4 stocks: Facebook, Amazon, Netflix, and Google. There were many in Silicon Valley that I heard were considering these 4 stocks a separate asset class all by themselves. These were the asset classes. When you compare it to bonds or gold, commodities, if you compare it to insurance, this was a completely separate asset class for companies. And I kept smiling. I'm a fundamental person. I look at stocks in terms of their revenues and their earnings, and that in relation to their stock price. And you'd expect faster growing companies would get a higher price relative to their earnings. You'd pay more for a company that was doubling every 5 years than a company that's doubling every 35 years, right? So there's a rule of thumb that the price earnings ratio, when you look at the price of the stock and divide it by the earnings per share they're making, that the growth ratio should be about equal to the price earnings ratio. Now, it's a rule of thumb, and it doesn't always apply, and there's exceptions of all sorts. But if you look at the PEs of those 4 stocks, Amazon is over 140. And yes, their revenues have been growing at 40%, but their growth in earnings is only going up 4%. Facebook, they're growing at 32%, and they had, at one time, a price earnings ratio approaching 100. Google's price-earnings ratio is 50, and they have a growth rate of about 25%. And the one everybody is really talking about has been Netflix with a price-earnings ratio of 147 for a growth rate of 40%. But the question is, how big are their markets? Can they continue to grow? All those are leaders. All of them are driven by algorithms and big data. And if you look at it, their potential markets look enormous. You know, Netflix has 120 million subscribers, and people are talking worldwide, billions of potential subscribers. But if you look at it in more detail, Disney has been removing their content from Netflix. TV program owners, those TV programs like Friends and some of the others, are taking back their Netflix. So Netflix is barred from doing those TV programs. So what Netflix has had to do is they've had to spend money to develop their own content. That's a real change from what they were doing. If you look at Amazon, one of the local ones, and everybody's thrilled about Amazon, Walmart's developed algorithms to compete, so Microsoft is competing on the cloud, so is IBM, so is Google. And the cable companies are getting there too. So all those four stocks, it could be well, but a lot of care has to be taken. Right now, those stocks are beginning to pull down. And when a bubble burst, as it seems to be with those stocks, I mean, if you look at the decline in those stocks in the last couple months, when a bubble bursts, it tends in the beginning to bring everything down. There's an old saying that the tide raises all boats, but when the tide goes out, you see who's swimming naked. You know, we seem to have entered a correction territory. Not just the FAANG stocks, but many of the tech stocks. It's called the tech wreck today. It's normal. It's a normal time. This is not 2007 or 2008. That was a credit crisis. This is not a credit crisis. This is a time in which times have changed. You know, if you look at the time period from 2009 to 2007, we were living in a low growth, low yield environment. We were recovering from the Great Recession. The Fed had its QE 1, 2, and 3. They were pumping money into the economy. They were buying bonds, and by buying bonds, they were pumping money into the economy. That was happening not just in the U.S., but it was happening worldwide. Interest rates were really maintained low. The Fed was keeping Fed fund rate at zero. Other countries were keeping interest rates low. In fact, there were countries that on their sovereign debt had negative interest rates. So if you bought $100,000 worth of bonds, you had to pay the government to own $100,000 worth of bonds. Negative interest rates of up to 5% per year. So if you bought a $100,000 bond, you might only get $95,000 back. That's what was going on in the world. Interest rates were low. Commodity prices were low. Labor cost, a lot of people talking about wages being stagnant. That was during that period of time from 2009 to 2017, even before that, but from 2009 to 2017, wages remained pretty stagnant. And that was, inflation was low. Inflation was less than 1% worldwide. In some countries, we were seeing deflation, where prices were decreasing. All of that was happening during the time period, 2009 to 2017. But now we've entered a different time. We're entering a high growth, high yield environment. Growth has picked up. We saw the last quarter growth in GDP of 4% versus 2.5%, 3% before. The Fed has begun to raise rates. In the past, every time that rates have been raised, it's been negative for the market and the economy. Unemployment is low. Wage rates are increasing. Commodity prices are increasing. Inflation is picking up. We've got the tariffs to deal with. We've got currency risk. And all of that is having a worldwide impact. Add to that the election and what some people see as a blue wave coming. The odds are that the House will be controlled by the Democrats. The odds are that a lot of the programs will be slowed down. and there's talk of even an impeachment. All those things are weighing on the market. We're in correction territory. The thing is, we're not headed toward a 2007, 2008. We're headed to a leveling. We're headed to a time in which the froth is taken out. Things return to a more normal phase, and we see a growth that's real. We are in one of those times. Don't panic. Psychologists talk about a deprived superreaction tendency. We tend to call it loss aversion. Investors irrationally avoid risk when facing potential gain and seek risk when there's a potential for loss. We all know the idea is to buy low, sell high, but a lot of investors execute buying low or buying high, selling low. Don't be one of those. We've got a lot of positive things going forward. Don't panic now. Things will get better. Just hang on. And I will be back next week with even more to cover. So have a very great weekend and a great week.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams here on AM 1590. The Answer. The preceding program was sponsored by Adams Financial Concepts.